Good afternoon, everyone. After an engaging session on the M&A deal structuring that we hosted in May, we have great pleasure in welcoming you all to our fourth webinar in the series of transaction tax webinars on acquisitions under the Insolvency and Bankruptcy Code. As you can see, if we go to the next slide, the way we have put out this presentation is to give you a brief introduction on the IBC proceedings along with the key tax challenges that we have seen the industry face in acquisition of IBC assets under IBC. There have also been litigation, particularly tax litigation under the IBC, which we would like to take you through, and how these are impacting acquisitions and structuring thereof. And the regulatory framework has also been evolving, and therefore we will take some time to talk about some of these regulatory considerations that you should bear in mind while considering an acquisition under the IBC. And finally, we'll take you through a few case studies on the modes of acquisition of assets under the IBC that we have seen in the recent past. I'm joined by my colleague partner, Suvira Agarwal, who will also be contributing into this session as we go along. If we go to the next slide, essentially the background. Now, we all know that IBC has been a culmination of the recognition that businesses can fail, and there should be a legislative framework that helps to revive such businesses or wind them up in the best interest of the stakeholders. In the past, India has had a string of legislations which provided for a framework for reorganization of businesses over the years. And notably, some of these legislations included the Partnership Act, the Companies Act, the Sikh Industries Companies Special Provision Act, the Securitization and Reconstruction of Financial Assets and Enforcement of Security Interest Act, and the Recovery of Debt Due to Banks and Financial Institutions Act. Given the multiplicity of the legal framework and with increasing instances of insolvency-related litigation in India, it was felt that a comprehensive legislation should be put in place to remove multiplicity and fragmentation, and also to give a clear time-bound process under which insolvency matters should be dealt with, and put an end to the unending extensions that bank moratoriums on bad loans had created. At this stage, it would be appropriate to reiterate the objectives with which the IBC was put in place. The first being resolution of sick companies or companies that are going under insolvency. The second being to maximize the value of assets of the corporate debtor. And the third being to promote entrepreneurship, availability of credit, and balancing of interests of all stakeholders in an insolvency proceeding. The order of these objectives is sacrosanct, and IBC is now seen as a key reform of this government, which has shifted the balance of power from the debtor or the borrower to the creditor. It has also instilled significantly an increased sense of fiscal and credit discipline to better preserve economic wealth of organizations and of the country as a whole. Over a period of 5 years, the code has undergone extensive changes catering to the present needs of business and staying in line with the intended objectives. This included the landmark introduction of a pre-packaged insolvency process for MSMEs that happened around the time the pandemic was in force. If we go to the next slide, you'll see the journey, how IBC was introduced and how it went through to becoming a law. In brief, the IBC was introduced in the Parliament in December 2015 and was thereafter referred to the JPC. There was some delay between December and April of 2016, where the JPC studied, analyzed, and incorporated changes that were originally recommended by the Bankruptcy Law Reforms Committee in November of 2015. Finally, it became law on 28th May of 2016. If we go to the next slide, this slide we've intended to capture the essence of when, who, and how an insolvency process can be initiated and how the resolution works through the NCLT. All of this is captured under Section 4, essentially, of the Insolvency Code. Some of the key recent changes that have been notably enshrined in the law now are one, the raising of the limits of the minimum threshold for the default, which was earlier 1 lakh till March of 2020 and was raised to now the limit of 1 crore. This was done keeping in mind the onset of COVID, and it was also clarified that the 1 crore limit is prospective in nature. That is, it applies to defaults post 24th of March of 2020. Given the pandemic situation, there was also a suspension on the filing of IBC applications for a period of 6 months from the end of March 2020 till October 2022. As you can see, the corporate insolvency resolution can be initiated by a financial creditor under Section 7, an operational creditor under Section 9, or a corporate debtor under Section 10 of the Code. There's one key judgment interpreting the outer time limit to apply for corporate insolvency resolution that has come out in the matter of Babulal Vardharji Gurjar. And the Supreme Court has actually clarified that the limitation period for application under the IBC is a three-year period as per Section 137 of the Limitation Act. And this period commences from the date of default and can be extendable only by following the process of Section 5 under the Limitation Act. That is, it means that you need to make an application making out a case for condonation of delay under the Limitation Act if you had to move for corporate insolvency under the IBC code. If we move to the next slide, this slide is a synopsis, and I'll kind of move through quickly on this to come to the tax issues that we want to focus on. Obviously, a corporate resolution application can be filed by any of the three constituents that we just spoke of. However, if it is filed by a financial creditor or a corporate debtor, then such applicant also has the right to propose the name of a person who can act as an interim resolution professional. And on admission of the application, the adjudicating authority, that is the NCLT of the jurisdiction, has the powers to pass orders, including an order to declare moratorium on recovery proceedings, order to cause a public announcement on the initiation of corporate insolvency resolution process, and call for submission of claims under Section 15 thereof, and appoint an interim resolution professional in the manner laid out as per Section 16 of the IBC code. The public announcement is required to be made immediately after the appointment of the interim resolution professional. Now, the interim resolution professional therefore steps in and is required to collect all claims received against the corporate debtor and determine its financial position. He is then required to constitute the committee of creditors, and the first meeting of the committee of creditors is required to be held in a time-bound manner, that is within 7 days of its constitution. The committee of creditors in itself, in its first meeting, should also vote to appoint the interim resolution professional as the resolution professional or to replace him by another resolution professional. And a majority vote of not less than 66% of the voting share of the financial creditors is required for this action. The first and foremost duty of the resolution professional who is appointed thereafter is to gather all relevant information around the company and disseminate this to interested applicants who are willing to participate in the revival of the company through a resolution plan. Once a formal application is made evincing interest, the applicant is also given access to relevant information in physical or electronic form by the RP. The publication of the particular setting out the invitation of expression of interest to submit a resolution plan should be done within a period of 75 days from the insolvency commencement date. And the resolution professional is thereafter required to assess and present the bids to the committee of creditors for their approval to consider the most suited resolution plan which conforms to the conditions prescribed under the Insolvency Code, essentially section 30 thereof. Now, once approved by the committee of creditors, the resolution professional is required to submit the resolution plan to the NCLT. And as the adjudicating authority, the NCLT, once it is satisfied that the resolution plan approved by the committee of creditors meets the requirements under the relevant provisions of the IBC, can pass an order to approve the resolution plan. Now, the interesting part here is that a resolution plan is not limited by the provisions of Companies Act in its coverage, and therefore is much wider than the coverage of a scheme of arrangement that typically would be envisaged under the company law. And therefore, the resolution plan as well as the order of the NCLT under IBC for this purpose has a much wider coverage as compared to a typical scheme of arrangement that you would have seen in normal company law process. If the NCLT does not accept the resolution plan, or if the plan is not received or approved by the committee of creditors, then the corporate debtor can also get liquidated in the same law. And the existing insolvency resolution professional continues to be a liquidator of the company subject to his consent. Now, liquidation and its tax consequences are not subject matter of discussion for us today. And our focus is to highlight the tax implications arising during the course of an insolvency proceeding. If we now move to the next slide, we have kind of highlighted a few landmark cases that have established the regulatory framework under IBC, but have also established principles of how tax authorities will be looked at from the order of their own position in tax litigation of such companies. So, for example, in the matter of Jet Airways Limited, the Supreme Court held that all government authorities, including tax authorities, are bound by a resolution plan once it is approved by the NCLT under section 31. In the matter of Monet Ispat, the Supreme Court has held that section 238 of IBC is an overriding effect, and anything inconsistent with any other enactment, including the Income Tax Act, will not take precedence. Therefore, income tax dues, being in the nature of state debt, do not take precedence even over secured creditors who are private persons. This case has actually helped in establishing the waterfall mechanism as well that is to be followed in resolution plans for payment to various stakeholders. Further, if you see how Dishnet Wireless, how the Madras High Court looked at the matter of Dishnet Wireless, was that Income Tax Department was given a power to pass orders on reassessment, which was initiated during the pendency of the corporate insolvency proceeding, where the company did not obtain any concession from the tax department while giving notice to the corporate insolvency resolution professional. So to that extent, Madras High Court in a sense, gave some handle to the tax department to pass orders while the corporate insolvency proceedings were pending. However, in the case of Leo edibles, the Andhra and Telangana High Court held that the department cannot claim any priority in payment of liquidation. So in the event of a liquidation of estate of a company, the department cannot go ahead and attach properties without following the principles of the liquidation proceedings under the IBC. And therefore, the priority of payment would again get established with respect to Section 53 of IBC as far as liquidation proceedings was concerned. And finally, in the matter of Om Prakash and Agarwal, the NCLT again reiterated the principle that was established in the matter of Monet Ispat and held that recovery of government dues, including TDS dues, would be governed by the waterfall mechanism under Section 53 in the event of a liquidation. And the company in liquidation under IBC would have to necessarily follow the waterfall mechanism under Section 53, which would have an overriding effect on provisions of Income Tax Act, including the provisions of withholding tax. With that, I want my colleague Suvira to step in to take up the ensuing slides. Suvira, over to you.
Yeah, thanks, Sridhar. So I'm just continuing the discussion which Sridhar did in the last slide. So as far as the department's claims are concerned, we've divided them into three parts. One is where the company has filed their returns and the department has clarity as to what could be the tax liability pending. Second is a situation where there is an ongoing litigation. And third situation also comes up where the corporate debtor has not filed the returns at all. So in the first two situations, the principle which Sridhar laid out in the first slide, in the earlier slide, that the department files its claims, it is considered to be an operational creditor. And whatever the resolution applicant offers to settle is what the department gets. Beyond that, the department cannot ask for any payment after the matter has been approved by the NCLT. So they will also fall within the circumference of the waterfall mechanism. They will be treated as operational creditors, and like any other unsecured creditors, they are just one of them. Now, the third situation is a bit particular, and this is a contagious situation, basically, that if the company has not filed the returns, the department does not have the visibility of the tax liabilities of the company, and therefore they do not have a basis to file the claim. In this kind of a situation, it could be a sticky situation for the resolution applicant, because the department can come out later on that we did not have a basis to file the claim, and therefore once the matter is settled, they can still come and demand their dues. Let's move to the next one. So in the next 4 or 5 slides, we are discussing the most talked about topic in the resolution applicants, that what happens to the liabilities which the corporate debtor has not been able to pay. So again, waterfall mechanism applies. That's absolutely correct. But what we have seen in most of the cases, it's never a situation where the resolution applicant is going to pay off 100% of the pending loans and liabilities. They generally pay a certain portion and the rest has to be taken care of. Now, when I say taken care of, if those liabilities or the bank loans are written off, then what could be the possible tax implications of the same? So Section 28(1), what it says that if an assessee has any income from business or profession, then that income is subject to tax. Now, in a situation where the corporate debtor is not engaged in the business of lending, then you cannot say that this liability which has been waived off becomes the income of the corporate debtor, and therefore it is not taxable under 28(1). 28(4), what does it say? It says if I have got any perquisite, any benefit from the company in a non-monetary mode, then that should be taxable in my hands. Waiver of loan, of course, it's a benefit for the corporate debtor, but it is not non-monetary. It is akin to be a monetary benefit, and therefore it is not taxable under 28(4). However, this latest introduced 194R, this again is a point of discussion. So there could be a situation where the bankers may be required to deduct TDS on the quantum of loan being waived, because a very tricky point in 194R, it is saying that you do not have to test whether the income is taxable or not. It is distinguishing from the section 195, which talks about the obligation to withhold tax when the income is taxable. Here, they are not talking about the taxability. So despite the fact that we are saying that the right of loan should not be taxable under 28(4), there still can be a withholding tax obligation on the banker under 194R. 41(1), basically, again, if it is a capital loan, if it is a loan taken for capex, basically, there we can say that though it is an income, but it is in the nature of a capital receipt and therefore should not be taxable. However, similar view cannot be taken in case of loans taken for working capital. So in that situation, we end up paying normal tax, provisions under the normal tax, basically. Move ahead. When it comes to your business liabilities, basically the trading liabilities, here also the position is similar as in case of working capital. If these trading liabilities are written off, they will be treated as income under the normal accrued interest which are being waived off. If I have claimed those interests as deductions in the past, then it becomes taxable, else it should not become taxable as per section 41(1). Further, there is this section 43B, which says that interest is deductible only if I have paid it. Now, if it is just an accrued interest and I have not paid it, then in that situation also, it should not be taxable in the hands of the corporate debtor. Now, how do I take care of these tax liabilities which may come upon me while structuring the acquisition? When I say me, I mean the corporate debtor. These tax liabilities would come in the corporate debtor. So how do we take care of them? Now, if there are accumulated losses or depreciation, then these liabilities can be set off against those accumulated losses or depreciation. And in the subsequent slides, we have talked about what could be the options for structuring this acquisition and what could be the MAT implications. Now, when I write off a loan, there are two ways of recording it in my books. One is I record it as a credit in my P&L account, and the other is I make an adjustment through the reserves. The moment I make it a credit in the P&L account, it leads to an increase in my book profits, which means that I am obligated to pay MAT on those book profits. As far as the MAT provisions are concerned, the government has not given us any waiver from the applicability of MAT in such a situation. However, they have given us a concession in the form that while calculating MAT, the total of accumulated book losses and depreciation would be allowed as an adjustment. In usual scenario, it is higher of the two is allowed as the adjustment. Here, it is both clubbed together is allowed as an adjustment. Then there is a Supreme Court ruling in the case of Jindal, where it was held that if you have adjusted the right of the loan through the reserves and the auditor is agreeable to that adjustment, then since the entry has not been routed through the P&L account, there will be no MAT implications. And finally, if the company is following section 115 BAA, which is the 22% tax under the new. Let's move to the next slide. Yeah. So this is an example which we have said. What we are saying in this example is that there is a long-term loan of 6,000 crores, out of which 200 crores is being paid and 4,000 is being written off. Similarly, there are operational creditors of 8,000, 3,000 is being paid and 5,000 is being written off. Now, if this 4,000 which is being written off, if this loan has been taken for capital purpose, then under the normal provisions of tax, there should be no tax implication. but there will be tax implications on the 5,000 operational creditors because we are going with the assumption that these are for the working capital. However, as I said, this entire 9,000 can be, or I would say the 5,000 can be adjusted against the carried forward tax losses and unabsorbed depreciation. Now, if the entire 9,000 has been routed through the P&L account, we can move to the next slide. So here is an example by which we can try to avoid a tax implication on the write-off of the loan. So one option that we have seen being implemented is that the loan is converted into optionally convertible preference shares, where you do the conversion at 5627B value, which is basically a DCF valuation of the company. And basis the valuation, a certain portion is recorded as capital and the balance is recorded as a securities premium. So rather than writing it off, it's recorded as an optionally convertible preference shares, which can either be redeemed or converted into equity in future. Let's move ahead. In this option, what we are saying is that if you see the financial situation of the company, it has an equity of 1,000, a reserves of minus 800, a debt of 1,000, and an asset of 1,200. So basically, the net worth of the company is 200. So in this, what we are doing is that we are saying you first get the loan assigned to the corporate, to the resolution applicant, and then, sorry, it's the other way around. What we are doing in this is that the lender is converting the loan into equity shares, and thereafter the resolution applicant is acquiring them. Now, in this situation, what happens is that when I convert the loan into equity, the net worth of the company goes up. And there a section 56 issue may come up, because if I continue to acquire the equity shares at the value of 200, whereas the net worth of the company has gone up, then I am not complying with section 56. I am avoiding any MAT or normal tax implications on the loan write-off, but 56 could still be an issue for me. And this we have seen in the past, particularly in case of listed company, where the 56 value is determined on the basis of the market traded value of the listed entity. At times, the resolution applicants are not able to comply with the 56 value, because the moment it comes in the market that there are bidders and there are good standing bidders for the corporate debtor, the market price starts increasing. So 56 is an issue in these kind of restructurings. Here what we are saying is basically that the resolution applicant acquires the debt and thereafter converts it. Here the advantage to us is, since I have acquired the debt and then I am converting it, there I have the flexibility of the value at which I do the conversion. And therefore, I will be able to meet section 56. Because here I have taken the debt, even if the value of the company has gone up to say 600 crores or 800 crores, then also I can say that I am going to convert it higher than the book value. I will just monitor or modify the number of shares into which the loan is getting converted. However, since the equity shareholding is not going to an external party, I'm fine with it as a resolution applicant. So this option works out to be better, that you get the loan assigned from the bankers to the resolution applicant at the agreed value, and thereafter we do the conversion. Over to you, Sridhar.
Yeah, thank you, Suvira. So the other interesting element that all of us have to be careful around is the carry forward of losses at the entity level. And with respect to carry forward of business losses, we all know that section 79 imposes a general restriction on carry forward and set off of losses in subsequent years, where there is a change in the beneficial shareholding of more than 49% in the company. Now, we all also know that this does not apply to carry forward of unabsorbed depreciation. Now, through an amendment in 2018, there was a specific carve out placed in section 79, where the provisions were not made applicable in the event of a change in shareholding of a company pursuant to a resolution plan approved under the IBC. Now, there was only one significant rider, that a reasonable opportunity of being heard has to be given to the jurisdictional principal commissioner of income tax or commissioner of income tax, as the case may be. And this would understandably be in the corporate insolvency resolution proceeding, while it is not as clear as it is so stated in the section itself. Now, given that the order of the NCLT is binding on the tax department, it is also prudent, and usually we have seen resolution plans asking for a specific carry forward of the tax loss in the plan itself. Now, the jury is still out on whether the Commissioner of Income Tax can deny carry forward in his order, if any, under Section 79. And we would think that it's prudent for government to issue a clarification to preempt any unwanted litigation on this matter. Now, a harmonious reading should give us the conclusion that where the resolution professional in the course of corporate insolvency proceeding has given an opportunity to the jurisdictional commissioner of income tax to lodge his claim as an operational creditor, but also to separately respond to the issue of carry forward of loss under Section 79 of the Income Tax Act. And in such a situation, the provisions of 79 should naturally kick in, and it should be a formality that the Commissioner of Income Tax cannot deny any such claim. Now, if the commissioner were to object carry forward of the loss, the NCLT has to deal with the objection in the resolution plan itself. Now, if the PCIT chooses not to participate in the proceedings, then there is no need to go back to the commissioner or the principal commissioner for an order under Section 79, and the law and the losses should be available to be carried forward, irrespective of whether the NCLT or the adjudicating authority gives a specific direction in the resolution order or not. Another interesting amendment was carried out in 2021. Now, this amendment was clarifying that the carry forward of losses of subsidiaries of companies under IBC are also covered, provided the order was initiated under Section 242 of the Companies Act, which is essentially by the central government relating to operation and mismanagement under its powers under 241 of the Companies Act. By inference, what it means is that any change in beneficial ownership of a subsidiary under normal IBC proceedings, that is where the central government is not involved or has not invoked Section 242 or 241 of the Companies Act, then the carry forward of losses of such subsidiaries of companies under IBC may not be available, given the fact that the beneficial ownership of such subsidiaries is changing from what it was previously. So to that extent, there is an inference that consciously the government seems to have decided not to give this benefit unless the central government alleged an operation and mismanagement under 242. This may not have been perhaps the intention, but the way the second proviso is worded to Section 79 due to the amendment in 2021, it is possible that the tax authorities will deny the carry forward of losses of subsidiaries of companies under IBC. There's also lack of clarity on what happens to the plans that were approved prior to the financial year 2018 on their ability to carry forward tax losses, and also whether the relaxation of carry forward of tax losses can be availed for future restructuring, which are outside of the resolution plans as well. So therefore, it's very careful. We have to take a very, very careful view from a tax perspective on how a resolution plan is kind of put in place, so that all of these elements are captured as distinct steps in the resolution plan itself. Now, if we were to kind of go to the next slide, the example that we wanted to give here was specifically around how the exemption would play out under Section 79. So if you see in this situation where a bid company infuses funds, which gives it a controlling stake, while the promoter's shares are reduced through a capital reduction mechanism without a cash payout to such promoters. Section 79 does give an exemption in this situation to the losses of the private limited company, that is the target company, on account of the fact that such a change of shareholding is happening pursuant to a plan approved under the IBC, with the rider that the jurisdictional commissioner or the principal commissioner of income tax has applied his mind and has had an opportunity, a reasonable opportunity to be heard in the corporate insolvency proceedings, particularly with respect to Section 79 in itself. And therefore, this is important for us to establish in the proceedings itself that this opportunity was given. And needless to say that if this private limited company had a subsidiary and that subsidiary also had losses, in the conversation that we just had in the previous slide, the subsidiary's losses will not potentially be available on account of a change of shareholding of the parent company, which is under IBC, but not therefore getting covered by the second proviso that was introduced in 2021. I'll kind of get back to the next slide on the provision on how Section 56 and 50 CA have played out. And if you see, there is still mischief and havoc that gets created under these two sections, that is 56 to 7B as well as 56 to 10 and 50 CA on matters relating to IBC in itself. Now, to just exemplify how this plays out is, if you would see 56 to 7B in principle says that the company issuing the shares to a resident, if the shares were issued at lower than the fair value of the such shares, then the company, if 56 to 7B talks of the premium that the company gets in terms of if it was to issue shares to residents above the fair value, and in that situation, the company is liable to pay tax on such premium. While there is an exemption for startups from this mischief, in practice, any company under an IBC, if it were to convert its loan or if it were to issue further shares, it has to be carefully evaluated whether that premium that it receives on conversion of the loan or on issue of shares does not trigger Section 56 to 7B provisions. The same situation applies on the other side, on the recipient of the share as well, which is the mischief that is covered under 56(2)(10), where any benefit that accrues to the shareholder on account of the share being issued to him or being transferred to him at a price which is less than the fair market value for this purpose would then get taxed in his hand as a benefit. And here, I think the key would be to see what would be the fair market value assessment of these shares. And typically for transfer of shares, and particularly for equity shares, the fair market value is benchmarked under Rule 11 UA to the book value of the company, subject to certain adjustments that are prescribed under the rule itself. So therefore, this section also does not carve out any exclusion for IBC proceedings, and there needs to be a very careful evaluation of how shares are transferred and or are given to the shareholders under a resolution plan without impacting the tax on the recipient of such shares under 56(2)(10). There's also a mirror section, which is particularly section 50CA, which talks of a deemed value on the sale of such shares or transfer of such shares for the purposes of computing capital gains, which means that if the seller of these shares was not getting the underlying book value as captured under the 11 rule 11 UA relating to those equity shares, then there is a possible deemed tax that can accrue to him on account of capital gains on transfer of such shares as well. Now, the interesting piece is if there are shares other than equity shares, then the fair market value assessment of these shares also shifts to the basis as determined by an independent valuer or a merchant banker. And here, that in itself can also play out very differently if other forms of shares were considered to be in play while we draft out a resolution plan. And therefore, all of these three sections bring to are here to kind of, we wanted to highlight this particularly, that these three provisions, including the provisions of carry forward of loss, essentially are significant tax issues that you have to address while drafting a resolution plan, and these become significant areas of concern as well, unless the government decides to waive or decides to change the law to relax this for IBC proceedings. If we were to move to the next slide, we have an example where there are three situations, and the situation on the top is same, where there is a bid company which is issuing further, getting further shares issued to itself from the target company, and there is a capital reduction on the other side. There are three possible situations that we have envisaged where if the fair market value of in case one of the company was 11 rupees, and why should that be 11? Let's take a logical example that if this company had immovable property of significant value in its being carried in its balance sheet, then there is a possibility that the fair market value of such share could be higher, despite the company potentially not doing well or having losses as well. So that's the situation that you need to be carefully watching out for. Now, in this situation, 11 rupee fair market value share is issued to, say, the bidco at 25 rupees, which means that the company has essentially got a 14, while it's got a 15 rupee premium, 14 rupees are not justified on account of the amount being higher than the fair market value under 11 UA. And to that extent, there is a possibility of tax applying to the 14 rupees in the hands of the company under section 56 to 7B in this situation. In case 2, while the fair market value is very low, the face value being rupee 1, if we were to apply the logic of case 1, the tax department should be arguing that 9 rupees, that is the 10 rupees at which the shares are being issued at, is not reflected by the fair market value, and therefore 9 rupees should also be taxed. Thankfully, that mischief is not covered by section 56 to 7 B, for the reason that any price only in excess of the face value can logically be charged to tax on account of the mischief under that section. And therefore, to the extent of the face value, there should be no tax implications. Now, having said this, there is a provision under Companies Act for companies to be able to issue shares at a discount from the face value. Without going into that complexity, the fact that the face value becomes the lowest possible value at which the share can be issued is the basis of this understanding. And of course, there is no premium in itself that the company has obtained in doing this. Now, in case 3, what we are seeing is that there is a transfer of shares. So the fair market value is 12 rupees, and the company, there is a transfer of shares from the existing promoters to, say, the bid company at 8 rupees, which means that the excess of the fair market value over the acquisition price, which is 8 rupees. So the 4 rupees, that is the difference between 12 and 8, gets taxed in the hands of the acquirer because he has paid less than what the fair market value is in coming to acquiring these shares. So essentially, a fairly quagmirish situation for all of us to watch out for, particularly in IBC proceedings, on how shares get acquired or transferred or issued, and how losses play out in carry forward. So with that, I'd like to kind of bring this out to Suvira for the next slide.
So till now, we were talking about the liabilities arising out of past transactions of the corporate debtor. But as we discussed, in the process of acquiring the corporate debtor, a number of tax implications arise. And we've seen that in resolution plans, people make provision that whatever tax liability arises in the course of the resolution plan, the NCLT would grant them a waiver. However, in practice, the NCLT does not grant you a waiver, and therefore this webinar which we are holding today is to emphasize the fact that you need to properly structure the transaction so that you can minimize the tax liability, because the NCLT will not overrule the department with respect to the tax liabilities arising in the course of the acquisition itself. The second thing which is of consideration is that, there is this section 35DD, which in case of a merger and acquisition, if you've incurred any restructuring cost, you are usually allowed, that expense is allowed as a restructuring cost, and it is a revenue expense which you can claim as a deduction under section 37, and you claim it over a period of 5 years. Now, in the course of the IBC process also, section 513 basically defines what is basically the resolution process cost, where they have covered interim finances, fees, whatever the cost RP is incurring in running of the day-to-day businesses of the company. So there is a restructuring cost element even in the course of an IBC acquisition. However, the CBDT has not clarified whether you would get the benefit of this restructuring cost as a revenue expense deduction under Section 37. So this is kind of a question mark which still needs to unravel. Section 80, basically what it says is that if an SSE has not filed a return in a particular year on time, then if there are any losses in that particular year, you will not be allowed to carry forward those losses. So they will not be available to you in future. Now, when a company goes into insolvency, there is a certain time lag before an RP is appointed. So in that situation, what used to happen is that in that period, if the return has not been filed, and these are all loss-making companies, the loss of that particular year used to get lapsed. To take care of that situation, that because there is a period in which there is nobody to take care of the management of the company, 140 was under Section 140 in the Finance Act 2018. They have allowed the IRP to sign the income tax returns of the company, so that to the extent possible, there is no lapse in the filings of the tax returns of the company. Now, as far as the applicability of GAR is there, there was a CBDT circular clarifying that on what all situations GAR can be applicable. And further, there was a clear exemption provided in that circular, which says that if a restructuring has been blessed by the NCLT, and the fact that these tax liabilities are being waived is clearly provided in the plan itself, then GAR cannot be made applicable. And our thought process is that since, and we've seen enough and more litigation around the tax, the liabilities or the carry forward of these liabilities post the resolution plan is through. And since all of this is talked about in the resolution plan, it is provided in the resolution plan, and that resolution plan is approved by the NCLT, GAR should not become applicable subsequently vis-a-vis the past liabilities of the company. Let's move ahead.
Yeah. So, from carrying on from the tax side to the stamp duty and some of the other regulatory slides, in interest of time, we will kind of move quickly on this. Stamp duty, again, there is no specific exemption provided under any stamp duty law, state or central, from applicability of stamp duty on IBC related cases. Now, there are three views possible here, and we have kind of articulated each of these. But really, transfer of assets of a stressed company, in essence, doesn't seem to be free of litigation or free of the mischief of stamp duty application. And this was specifically brought out in the case of Monet Ispats, where the NCLT rejected the plea for exemption from stamp duty provisions on transfer of assets pursuant to a resolution plan. Now, there is also a view that if the stamp duty exemption is sought to be enshrined in the resolution plan, which is that it is specifically called out for, the NCLT has to decide on a case-to-case basis on applicability of stamp duty. Now, that is what happened in the resolution case of Synergies Dore, and while the stamp duty exemption was demanded, the NCLT did not provide any direct observation on this matter. Logically so, because stamp duty in itself is a matter of applicability of law, and NCLT would have gone beyond its ambit to specifically direct a non-applicability of the provision if it was so. Now, if we move to the next slide, essentially we have captured how Companies Act has played out with respect to IBC proceedings, and the most significant amendment is the amendment to Section 53, which was carried out to say that there should be flexibility for creditors to convert their debt into a discounted value share, which was earlier prohibited by the applicability of Section 53. So now this amendment actually says that a company, if it were going into insolvency proceeding, can issue its share at less than the face value, which means a discount is possible in this situation. And to that extent, it helps the creditors who are not inclined to buy at a higher price. Now, this could be done legally. This could not have been done legally earlier. Now, if we move to the next slide quickly, there are a host of changes that SEBI brought about in respect to listing regulations as well as takeover code and delisting provisions. In summary, I think Suvira touched upon it. As far as the ICDR regulation is concerned, the most relevant issue that everyone is facing today is that while SEBI ICDR regulations have been relaxed from looking at a pricing of 26 weeks average week high or low as compared to a preferential allotment that would have been done. And while there is a relaxation, the SEBI regulation still expects the pricing of preferential issues to be not less than the weekly high and low of volume weighted average prices of the concerned share during the 2 week preceding the relevant date of issue. So there is still an issue here as far as SEBI has, while it has given a relaxation, it still measures the last 2 weeks price in the recognized stock exchange for pricing their shares in the event of an insolvency proceedings. And like Suvira just pointed out earlier, that the mischief of section 56 still catches up to this issue where the price can be manipulated to be higher, and eventually the person who buys these shares or gets these shares issued to himself is still liable to pay tax as if there was a benefit for these shares as determined under Rule 11 UA. So to that extent, a gap and a significant roadblock as well for transactions to happen. The other elements are around delisting, where delisting has been made much more easier for an exit under the IBC resolution plan. And as long as the resolution plan lays down a specific procedure to complete the delisting, or it provides for an exit option to the public shareholders at a price which is not less than the liquidation value as determined by the Insolvency Act procedure, and as long as you are within that parameter, it is possible to give exit under a delisting proceeding for such shares. Similarly, takeover code proceedings have been significantly relaxed to say that takeover regulations will not be applicable to a transaction proposed to be undertaken pursuant to a resolution plan under IBC. With that, I'll kind of pass on to Suvira to take the case studies, and from there on.
So in this deck, we have covered 3 modes of acquisition. One is the direct acquisition. In the second slide, we are covering the slump sale stroke the demerger option. And the last one, we are covering the merger option. In case of a direct acquisition, this is pretty simple, where the bidco infuses the funds into the target company, and then the target company uses it to settle the lenders. The balance which it is not settled, of course, will be written off. In this, the existing shareholders, as is provided in the law, their shareholding gets extinguished, and a provision for capital reduction is provided in the resolution plan. So here again, since I am doing an infusion into the company, and if the company is loss making, it has a negative net worth, I would be able to take care of 56(2)(10) because there will be no positive book value to be taken care of. And 56(2)(7)(b), it says that you cannot infuse at a price which is higher than the fair market value. So that I would any case not be doing. So 56 is taken care of. Of course, there would be issues around write-off of loan, where there could be taxability under the normal provisions or MAT, and therefore, as we have discussed in the earlier slides, some kind of a restructuring is always required with regards to waiver of loans. Move on. In this option, the why the bidder would want to adopt this option is when the bidder is not wanting to acquire the target company. There is some history to the target company which he does not want to acquire. So in this option, and this was not earlier being allowed by the NCLT, because the thought process around IBC was to acquire the company and to make it positive henceforth. But now the NCLT has started allowing that the bidder can acquire only the business of the company, in which case it is through a slump sale, where the business gets transferred from the target company to the bid company. And as per the income tax law, in a slump sale, to a certain extent, you can pick and choose the assets and liabilities which you want to acquire, as long as the business which you are acquiring qualifies the concept of a going concern, which means that whatever gets transferred to the bidco continues to function as an operational business after the acquisition. So in this, you will not have 56 issues. The debt, extra debt, everything is kind of being written off in the target company. The implication does not come on the bidco. The bidco gets a clean business. The other way of doing this restructuring is in that you acquire the target company and then you do a demerger of the business which you want to acquire from the target into the bid company. Now, why would a person, or how would a person distinguish as to whether he should do a slump sale or a demerger? See, in a demerger, there would be a larger time horizon. Depending on whether the company is listed, unlisted, there will be a 6-7 months time horizon for completion of the transaction, whereas slump sale is a quicker mode. However, as Sridhar mentioned in the past slides, there is no stamp duty exemption. So if I go through the demerger route, there is a possibility that I will be able to claim stamp duty applicability on the basis of the merger entries in the stamp duty laws. Whereas in a slump sale, I would be paying stamp duty on the complete conveyance value. So that could be a significant benefit when I am acquiring a business through a slump sale vis-a-vis a demerger option. Let's move ahead.
Yeah. So on this slide, what we are trying to say is that while the position on the previous discussions that we had with Suvira and others is that we are looking to dilute through a capital reduction. There are two elements that we are trying to bring out here, which are issues that you need to watch out for. First is the fact that a capital reduction in itself, does it trigger the provisions of section 56 on account of the shareholder not getting anything? However, the target company, if its book value was higher, would that be subjected as to a tax in the hands of the target company itself? Now the jury is out on this one. However, where shares are cancelled immediately or on the scheme becoming effective, the company actually does not receive any property in itself. And this is how at least the Mumbai tribunal had looked at in the context of buyback in the matter of Vora Financial Services, where it took a view that the provisions of section 56 to 7A should not be applicable and should apply only where the shares become property in the hands of the recipient of the shares. And in this case, the property should remain in existence, which it is not. So to that extent, there is a possibility to argue it in this manner that the cancellation of a share under a capital reduction is in itself not causing a benefit to the target company by virtue of the extinguishment of the share, and to that extent section 56 mischief should not apply. Now, having said that, it is still a gray area for us to kind of conclude on this in that manner. The other element that we are bringing up here is the fact that a merger as the last step in a resolution plan is also a possibility that can be embedded in the resolution plan, by virtue of which the carry forward of the losses in themselves also get covered, while also taking care of the position on the write-off of the loan, because we have in this step also taken over the loan at the value at which it is coming through. So to that extent, a fair bit of structuring possible in this manner as well through a merger, and this is something that courts have been open to consider, because the revival of the target company is ensured through the merger as well. So to that extent, it fits into the expectation of IBC as well. With that, I think we are at the end of our presentation, and I know we have stretched out more than 5 minutes into the time. So in interest of time, we will not take questions and answers, and if you have any questions, may we request you to share them over the chat and or through to us over email, and we will be happy to respond to those questions. We hope you had a good session today, and found this session to be fruitful. Look forward to interacting with you in the subsequent session. Thank you and goodbye.
Thank you.